attend, so you get me instead of Brad. Sorry for that. We've got a couple things on the agenda. We have BTC here. I'm going to change the order of the agenda and have BTC go first, and then we'll do any updates and follow-up administrative things after that. But with that, I think I'll turn it over to Alan. And I don't see, is Blake on yet? Because Blake is the one that had the majority of questions. He's not on yet, but will be joining us. So I think if we can just go ahead, Alan, and I'll let you get started.
All right. So first of all, I'm just going to work off of the 4 questions you sent me, Kathy. And the first question, we'd like to see the third quarter report. Ideally, we'll have that to you probably not next week, but the following week. So that's the answer to question 1 of 4. In the email I sent, and I don't know if you've seen this, other people have seen this, but the question was they'd like an update on the total value of the bonds coming to maturity in the next 6 months. That total value is a little over $1 million. And the second follow-on question was, well, what's the interest rate on these bonds? And what rate can we expect to reinvest those proceeds from, or at what rate can we expect to get on the proceeds or the reinvestment? So we call this roll-off yield. So what yield are we losing? That's 3.2%. And what's the estimated reinvestment rate? When I wrote this email, it was on March 31st, and it was 3%. There we go.
Welcome to the audio conferencing center. Please enter a conference ID followed by pound.
The estimated reinvestment rate is 3%. So rates continue to climb. So the probability that we can get something definitely in the 3% range is very good. We may be able to get something even a little bit better than that. We'll have to see. But rates continue to rise. I think they might have been off a little bit today, but in general, rates continue to rise. And reinvesting at a rate of 3% is very good compared to what we could have done 3 months ago or certainly 6 months ago. The third question, question C, basically, to sort of paraphrase the question, I want to make sure I'm fair to the question, but I want to paraphrase it. Looking for alternative asset classes or investments that could be made that are both lower risk, but also push growth. Basically, I think the question is getting at, are there other asset classes out there that we could invest in that are low risk but could provide higher growth potential and higher interest than what we're getting? And I'll start the answer, and I'll let John finish it. But in general, returns and the income you're getting are highly correlated with the risk you're taking. So it's very difficult to get higher interest or higher growth or both without taking more risk. And so one of the ways we've put forward previously, not a recommendation necessarily, but just here's how it works. If you want more growth in the portfolio, one way to do it is to increase the equity weight. Of course, that increases the risk. And ultimately, taking on more risk is a decision to be made by the board of the school district, because ultimately they're on the hook for the liability if the stock market, we increase the weight at their direction, and the stock market goes down and the fund becomes underfunded. The district would have to kick in money potentially down the road to remedy the funding or help the funding status. So John, I'll let you finish the answer or expand on that answer before we move on to question D.
Sure, and just to add on Alan's comments, yeah, anytime you want to increase your risk, or increase your return, excuse me, it usually entails an increase in risk. And obviously, numerous vehicles have been created over the last many years in attempts to circumnavigate that reality of the investment world. In many cases, those involve extreme levels of complexity, often with very little transparency and sometimes very little liquidity, which in and of itself creates a risk for many, many investors. So trying to increase income, increase growth within a very tight risk environment is very, very difficult to do. And as you know, your plan is constructed now on the fixed income side, predominantly in corporate bonds, which are higher risk than government bonds. They're still good quality bonds, obviously, investment grade. And then, as Alan mentioned, we have increased the equity allocation within the portfolio as well, which is something we can certainly review again. As you recall, we presented different scenarios with different allocations and the associated prospective returns and volatility levels associated with those mixes. So that's certainly something we can do again whenever you'd like.
Any thoughts or questions on that question? That's a pretty big, broad question, and we're certainly happy to expand on that and continue the discussion.
I think the reason for the question was, as I'm understanding Blake's question correctly, is that we have retirees who receive a certain rate of certain proportion of their savings every month. It's like a 4.5%. And we want to make sure that we can cover that long term. And if we have our bonds, which normally are receiving higher rates, being exchanged for bonds with lower rates, we would run out of money. So I think that's the question that we're trying to figure out is, will we be able to sustain our retirees without, having to go to the school board to pay for those extra liabilities?
Certainly, and that's our goal too. Our goal is to generate a sufficient level of return that is going to allow you, at a minimum, to meet all of the liabilities you have in regard to the retirees from the plan. So what we've been doing for the last several years, and I think we've discussed this before, is we have the income from the bonds. And the nice thing about your portfolio is years ago, when bonds were purchased, they were longer in maturity. So they're still hanging around in many cases. I think a very small percentage will be increasing in the near future or maturing in the near future. So it's like a ship. It does turn, but it turns very slowly. So you've got that aspect of your portfolio. The other part of your return calculation is the recognition of realized gains in the portfolio. And for a number of years now, we have been harvesting specific levels of capital gains in the portfolio to ensure that you achieve the necessary return to maintain your fully funded status in your plan. So that's our plan, that's our desire, that's our goal as well. So front of mind with everything we do in the plan.
Thank you.
Barb?
Any other thoughts or questions on that question before we move on to question D?
Yes, I believe Barb has a question. Go ahead, Barb. You're muted, Barb.
Oh, okay. Sorry about that. Just a couple questions. You stated that the reinvestment number at 3% was a lot better than 6 months ago. What was it 6 months ago? I mean, how much has it improved, I guess?
It would depend on what we would have invested it in. So I'm talking fairly generally, but to give you an example, trying to think here, what's the clearest way?
Well, hang on, Alan. I've got a very simple illustration, not totally applicable to your plan, but if you look at a 10-year Treasury note, a year ago, it was at about a 1.18% yield. Today, it is at 2.62. So this is just, once again, a very plain vanilla U.S. Treasury 10-year maturity. Last year, 1.18. Today, 2.62. So just to give you an indication of how much interest rates have moved, this is a 1-year example. I mean, they've moved, a lot of that movement has just been within the last few months. So the point Alan's trying to make is obviously the rates have gone up materially in a relatively short period of time. So the reinvestment of any cash flows or maturities now would be much better in terms of their yield than they would have been 3 months ago, 6 months
Sure,
ago, or in the example, 12 months ago.
So then, just what's the reason for that turnaround specifically, and do you see that continuing?
Well, basically what's going on is we have seen a dramatic increase in inflation. I'm sure you've heard about that, and obviously as a consumer, you've experienced it. Every time you put gas in your car, go to the grocery store, et cetera, you're seeing higher prices across a multitude of goods and services. So the Federal Reserve Bank is very much committed to trying to bring that rate of inflation down. The Federal Reserve basically has a 2-part mandate: stable prices and full employment. Well, our unemployment rate here in the United States went down to 3.6% last week as reported, or last month as reported last week. So we've got very low unemployment. There's a number called the JOLTS number, which is a number that looks at job openings. There are still over 11 million open jobs in the United States. So there's a lot of competition for good employees, and in some cases, employees in general. And companies are finding themselves being forced to pay more wages, which also feeds potentially into that inflation. So the Fed is now coming out. They made their first step last month by increasing the federal funds rate by 25 basis points. They've also communicated they have planned several more increases as they meet throughout this year. So that's what has been driving rates higher, is the prospect of the Fed coming in and raising rates numerous times throughout the year, taking some other steps too, which I won't go into, but which also prospectively could lead to higher interest rates. So that has pushed investors into demanding higher yields from their fixed income investments, and therefore we've seen those yields rise over the last few months specifically.
Great, thank you.
You're welcome.
Okay, let's see here. I think Blake has a question.
Yeah, my question is what would be our risk level now if you were to define or put, quantify that? I mean, certainly we've had the conversation multiple times about, where our risk level is and is not. And I certainly, the short-term conditions seem like there is a little favorability to our current allocation. However, we also know that can, as quickly as it moved in the last basically 90 days, it equally could move just as quickly in an additional 90 days. And, to expand upon what was shared by Jessica earlier, I'm struggling, number one, with whether 5 years, 10 years down the road, whether this plan has the growth necessary to cover our basic expenses, which I would call that the interest that is going to our retired members. And certainly a secondary portion of it has to do with active members. And yes, we're in the middle of this TCG study, but there are no guarantees. And I know that, in 2018, we had a guarantee and that fell through. And so I'm also hopeful that in this conversation that we're sort of also viewing a backup plan, what's the next step if things don't come together for active members. And I will express, as I've done in the past, that I struggle that we don't have a target, that we don't actually have a goal for where we expect income and growth to occur in this plan. And when I see, and I know I'm jumping a little bit ahead into letter D, but when I see 5.5% and 6%, I want to be clear to everyone that is not the kind of growth that allows our pension to keep up with the one that everyone can be rotated or flipped over to, which is IPERS. And so I acknowledge the risk. I want to know where we are from a risk level. And I also will remind all of us that Andrew Brosder, about a year ago, he talked about how this investment part is where the members assume responsibility and take risk. Management takes a lot more of the risk and responsibility when you think about on the retirement side and you look at the growth there and then also life expectancy pieces.
Do you want to start on that one, John?
Sure. In terms of growth or risk associated with your plan now, particularly in the context of 5 to 10 years, that's a long time period. As I mentioned earlier, your plan, particularly on the bond side, it is somewhat like a ship turning, but it is turning. So if we were to maintain the current level of interest rates for the foreseeable future, the plan would gradually have a more difficult time meeting its stated obligation in terms of that rate of return required to fully fund the retirees and meet its expenses. Obviously we don't know that as of yet. And as I mentioned earlier, we're always looking, are there other ways we can do this within a well-defined risk tolerance environment that can enhance the return. So one of the things is we've done, and you actually referenced that in one of the questions, we did allocate a specific portion of the portfolio to REITs, which have higher yields typically. It's not even true in all cases now, but we are looking for opportunities to enhance income on the equity side as well as add growth potential. So once again, we're constantly looking for opportunities to do that. It's very hard to say 10 years from now where interest rates will be or the equity markets. Lots of people throw those forecasts out, and often they are very much off the mark. So we look at what's in front of us right now and try to extrapolate that into the near term. As I mentioned earlier, we've seen a significant increase in interest rates already this year. And the prospect, at least from the Federal Reserve, is that rates are going to go up higher. So we'll be taking advantage of that should that occur. And once again, always looking for opportunities to ensure that we meet the required level of return to keep you fully funded with as much of a managed level of risk as we can. Right now, you have a pretty moderate level of risk from a market value adjustment change. And I think that's the one thing. We've talked to a lot of clients now about fixed income and the fact that they've seen the value of their fixed income holdings go down as a result of the increase in interest rates. Well, as we tell them, unless you sell those bonds, that doesn't mean anything, because if you continue to hold them until maturity, you're going to get the face value of those bonds. And particularly in your plan, market value fluctuation doesn't factor into the return as calculated. It's the income you receive and then gains and losses. So that's why I mentioned earlier, in addition to the income that we receive from the bonds and from the equities, we also have been utilizing realized gains to add as a component of that return to make sure we get to where we need to be. So, Alan, if you want to expand on that.
Well, I think Blake, do you, how much of that answer covers your question?
Yeah, I mean, I'm not going to lie. I'm surprised to hear your definition that we're at a moderate risk level. I'm a science teacher. I'm not a finance person, but I'm shocked to that word was not the word that I would use. But that was really the answer that I was looking for.
Well, and remember I said a moderate risk level based on market value. Given the fact that you're 30% equities, 70% fixed income, that would equate from a market value perspective, a moderate level of risk. a high level of risk from market variability standpoint would be if you were the complete opposite, if you were 70% equities and 30% fixed income. Because if you look at returns for bonds and stocks, stocks have a much wider variation of returns. When they go up, they can go up much more than bonds typically. They can also go down much more than bonds typically. So basically, when you look at one of the broadest, most widely used indexes of fixed income, the Bloomberg Aggregate Bond Index, going back to 1980, I believe, it's only had 4 years where the return was negative, only 4 times. So it's very rare for bonds to have a negative total return over a 12-month, over a calendar year. Let's specify that. Equities, obviously, we know that number can be much larger in terms of upside and downside. So that's behind my use of the term moderate.
Anything further on that, Blake, that we can expand on, or anybody else? Any related questions on that? Whoops, pardon me.
I guess I'm just wondering if we would adjust that, 35-65, does that put us in a different position in terms of our earnings? Would make any difference in our earnings rate and without changing it too much?
The thing, once again, going back to how the return is calculated, it's basically the income plus or minus realized gains and losses. Fortunately, over the last 10 years, we've had nothing but gains to use in the portfolio to supplement the fixed income return. So raising the equity allocation could potentially, if in up markets particularly, lead to the ability to take more gains. That is certainly a possibility. But also, once again, because of the higher variability of stocks, you do have that potential where if the market goes down for a prolonged period of time, you won't have a significant amount of gains to harvest. So I use it as an example to think back to 2000 through 2002, where you had 3 consecutive years where equity markets went down. And so the opportunity to have particularly any growth in the amount of unrealized gain you have is pretty limited as you see the overall market declining for 3 consecutive years. Or go back more recently to the great financial crisis of 2008, 2009, where the equity markets went down 37% as measured by the S&P 500 in 1 year. So, in those periods where markets are moving higher, yes, certainly, but you have to be prepared for the prospect of a declining market as well. Now,
yeah, and I think,
go ahead.
No, go ahead, finish your thought, John.
Yeah, typically in a retirement plan, you are focused on a longer term time horizon. And I think at least historically, the gains that you've taken in your plan have been smoothed over a period of time to take out some of that volatility. So that's another positive that could be a byproduct of increasing your equity exposure incrementally.
Yeah, John, I think that last point that you made is a really important one is, when we look historically at the DMTRS, you go back into the 80s, the 90s, the early 2000s, there was some smoothness, if you will, in those ups and down times, but ultimately, we were providing for members, active or retired, a competitive, if you will, pension. We were providing them at that time 50-60% easily income replacement. We were very close in alignment to where we are with IPERS. Where I'm struggling is as I look at the mathematics, the previous 10 years, I don't feel like we have as much of a smoothness. I feel like we are highly vulnerable to a larger drop and not necessarily having this is not going to sound right. So again, forgive me for my lack of economic skills here, but the safety net that maybe the bonds were providing to us for 35, 40 years, I don't see it there as much. The safety net of a 3%, which is better than a 2.5 or a 2 3/8, is true. For me, I struggle because I don't feel like as a plan, and this is not about Alan and John, what you all are doing. I feel like as a plan, we don't have a goal. We don't have a target. We don't have anything that we're aiming for other than please don't have a bad year. And I play the mathematics out as best as I can, just as any of us can, 5 or 10 years from now. And I don't feel like we have a good safety mechanism. I'm worried that the district is going to be on the hook one way or another, either because our performance is going to not achieve 4.5% and the district is going to chip in, or that we've taken a little bit more risk and say that there is a cycle that is, and I mean multiple year cycle that is negative, and we don't see what occurred like after 2008-9. To me, an important part of the conversation about 2008-9 is then what happened in 9, 10, and 11. And again, I think if you look back on our DMTRS history, that's where you really see. We didn't see as big of a drop in 8-9. We also saw a much smaller gain. We said that that same thing occurred back in 2020, 21, when we think about the craziness that's just occurred around COVID. We didn't drop nearly as significantly as a lot of other investments did. We also did not see anywhere near the growth that so many others did. And so I feel like, and I know that you said, I think it's been a couple of years since you all provided us that analysis of changes in the investment mixture and how it changes your risk and how it changes your potential sort of minimum maximum that you provided. Things are a little bit different than they were a couple of years ago. And perhaps as a group, we should go down that road again and have that full conversation, because I'm struggling with the long term and what feels like we're constantly talking about the short term, or we're constantly talking about the possible negative of one bad year and not always remembering that there are also equal opportunities of very positives in a year.
Well, that's a good point, Blake, but I guess what I'm thinking about is we know that this plan is now going to close. We no longer have new enrollees. So we know that eventually the plan will be finished. We don't know how long that will take. We don't know if actives will retire into a different plan or into the same plan. We don't know. We don't really know how it's going or how long it will take. And that's part of our TCG analysis for our actives is what are they recommending to ameliorate the problems that we've had with contribution rates between IPERS and DMTRS. So that said, I think one thing that we need to think about is what is our long-term strategy for closing this plan in a way that is fiscally responsible to the members of the plan, but also to the school district. So that's what I'm thinking about. I'm not expecting, John, that you would have an answer for that today, okay? But that's what I'm thinking about in the back of my mind is how do we close this plan down in a way that is fair, equitable, and fiscally responsible?
And I think for me, being mindful of closing down for actives, of course, has a different definition and a connotation in your context than what it may look like for retired folks, which is where, again, I have that, where is our long term? Because I'm not sure that the retired members, I don't know that we're going to see a change for them anytime in the next, in what I might call the short term.
Yeah, and we only have a, 150 actives right now that are actively contributing to the plan, and that number will get smaller and smaller and smaller, and that could happen gradually, or it can happen quite suddenly, depending upon how all this plays out for the actives. So in either case, we still need to be thinking about how those decreasing contributions will affect plan performance, because there'll still be people on the plan after all of the actives are no longer active. I mean, there'll still be people in the plan. How do we make sure that those people are treated fairly and equitably, clear up until their needs are finished, in a way that also doesn't harm our school district? So it's a problem. But it's something I think that we need to kind of be cognizant of as we are making decisions now, that we are really in the stages of closing the plan down. So what is that going to look like as we roll forward? And what do we need to do now to ensure that we have the funds that we need to see our people through to the end?
And that's obviously a big part of the role your actuary plays in terms of evaluating your assets versus your liabilities and determining, funding status, that type of thing.
Did you want to roll on to question D?
Sure. I think we kind of touched on it already a little bit, but the an approximation of the return for the current and the next fiscal years. John and the team did an estimate, and it falls between 5.5% and 6%. So basically, it's you can tell me, John, I assume you're doing a weighted average calculation based on historical returns for fixed income and equity to arrive at this range. Is that correct?
Right. What we're looking at is the cash flow from the investments, the interest and the dividends, and then plus adding a capital gain component to it. Right now, we still have some capital gains in the portfolio that we can utilize, and obviously that's the swing factor, because we don't know precisely, depending on how markets move year to year, what that will be like. But we felt fairly comfortable throwing the numbers of 5.5% to 6% out there based on what's currently happening and what we think in the near term we can continue to do.
Any thoughts, questions on that? Does anybody want more explanation?
Does everybody have the answers that they were looking for as far as the information that they need? Maybe not necessarily what they wanted to hear, but what they needed to move forward from here. Blake, are you comfortable with? Okay. All right. Well,
yeah, I think for me, Kathy, the question would be whether it is the will of the group to actually have that longer conversation similar to one we had a few years ago. Do we ask John and Alan to provide those sort of long-term projections of what might happen if we were to change the mixture? And I know it's tough having this conversation right now because we're waiting for TCG, but I also know that, I don't mean to be offensive to anyone, but we're already 2 months behind on where we thought we were going to be with TCG. And time is ticking, and the decisions that we make each cycle as bonds come to maturity does really matter. And I think I don't think that has not worked in our benefit the last 5 years.
I think if Alan and John, if you could prepare that information for us, that would be helpful. And at least then we'll have it to have some discussions on our end, and we can do it in tandem with the TCG study.
Okay, yeah, we'll work on that,
and that way we're not waiting. Once we figure out what the TCG study is, just starting on this, we've got that already in the works.
I just have another quick question about that. Is there any value, or would it at all be beneficial to look at this in 2 different groups in terms of how we invest? The actives who have a longer term taking on more risk, and I mean, I don't even know if it's possible to split it like that. Just curious. I think Blake had mentioned that a while ago, so I just wanted your perspective on that.
And I'm certainly not a plan design expert, but I don't know that would be something you could do as the plan is currently constructed. But once again, I'm not an expert in retirement plan design, so I don't have a whole lot to offer there.
Yeah, neither are we.
Yeah, well, not either. My simple mind says to me, Barb,
No way, huh?
No, it just says in round numbers. Think about it. If you're investing $100,000, you adjust rather than split it 50,000 and 50,000 into two different pots, you just adjust your risk tolerance in your portfolio accordingly. So if we were investing solely for the actives, our investment policy would look different than it does today.
Yeah.
But because we have the high concentration of retirees, that is why, we are at the mix that we're at. That's driving a lot of our decisions rather than having it in two separate pots. That's my simple brain explanation. I don't know, Alan, John, if that makes sense.
I think that's a good one. And from what I understand, this plan goes back to 1953, and the design was basically very similar to a life insurance company to some degree. And I think initially there may have only been allowed 5% equities. And of course, now you have a maximum of 30. So that's how it has evolved over the years to where you are today. But I think it was always, under the design meant to be this one plan that provided, a growth of retirement benefits for the actives while ensuring that the payments to the retirees were being distributed and simultaneously keeping the plan fully funded. So,
can I go back and revisit one topic that Blake had brought up earlier, and I just kind of want to reiterate what I remember in previous discussions regarding this, and then we can, Alan and John, if you would like to chime in, I would appreciate that as well. Blake, when you mentioned, a target percentage rate of return, I remember Andrew at that time and stating, and I remember Nick saying some of the same things at that time, was that they didn't want to chase a rate of return. Because if you're chasing, let's say we put 7% as our target, then that means we have to change our risk tolerance in some years to get to that 7%. And they weren't really comfortable with that. They were more comfortable with an investment policy statement that said what our risk tolerance was, and that hopefully that levels out some of our returns. And I remember that, but again, like, I understand you in your own personal investments, you look and you have kind of a target in your head of what you want to achieve each year. And that's how you adjust your portfolio. So I can see both sides of it. I just wanted to reiterate what I remember in our previous conversations for those who might not have been present in those.
Well,
yeah, go ahead, Alan.
Basically, you wouldn't change. It'd be really unusual to change your asset allocation year to year. What's more common in the prescribed way to determine an asset allocation is to determine your long-term objectives. So what do you want to get out of the portfolio, or what do you want the portfolio to deliver over a long period of time, 10, 20 years or longer? And you temper that with what restrictions or constraints you may have for risk tolerance, and that's driven by your time horizon. So how long you have to invest. There's lots of details to this, but the point is that the long-term historical return of the S&P 500, for example, which is large cap stocks, is 7%. So right away, you know that if you invested the entire portfolio, 100% of it, in U.S. large cap stocks, and right now I think the allocation is somewhere probably in the low 20s to U.S. large cap, and there's small cap and REITs and international, but just U.S. large cap, to keep it simple, we'll talk about that. Just to achieve a 7% return per year, you'd have to be 100% in large cap stocks. And so achieving above 7% would be pretty difficult on a regular basis. And I think of that a lot in terms of that sort of defines what the top end of the return would be on an annual basis. Now, certainly there are asset classes or the stock market in general that deliver a return that's much higher than 7% periodically. I can't remember what the S&P 500 return was last year, but the S&P 500 has averaged a 10% return for the last 10 years as of December 31st of 2021. Now there's a lot of thought that it may be a long time before we see a string of years where the average of the S&P 500 was 10 years. But the overall point is, when you think about setting goals about what return you want to achieve or what you can expect, the one thing that comes to mind right away is, well, if you were 100% in the S&P 500, you would expect no more than 7% a year on average over a long period of time. And then if you add fixed income, your expectation needs to be whittled down based on the amount of fixed income that you add. So I don't know if that's helpful or not, but that sort of helps frame expectations to know, well, what's the top end that you could expect on a recurring basis? And 7% is really the top end that you could expect on a recurring basis.
Yeah, and I think Kathy makes an excellent point in bringing that up, because, there are lots of examples out there where specifically defined benefit plans where they went through a period of time where they kept nudging their actuarially assumed rate of return higher. And then they got into environments where their investments weren't generating that return. And then the funding status of those plans deteriorated. And, there's still a number of them, typically in many cases an older industrial company where they still have these plans out there that are hanging over them that have huge unfunded balances, and partly due to the fact that they kept nudging that assumed rate of return up, and then when their investments couldn't generate the returns that they were anticipating, their funding status just, like I said earlier, deteriorated.
I think, though, it's important to note, though, I mean, we talk about, unfunded status. I would argue that what's happened is that unfunded number, instead of staying in a pot that is, in a sense, against the district, it's actually gone on the members. What's happened for us is that performance has just dropped and dropped and dropped and dropped. So I would actually say that it's the exact same net effect. It's just that in our plan design, it's being held in the pension of the employee and not in the liability of the employer. And so I actually see it as one and the same, because I mean, I actually think, Alan, that was a really good explanation. I like that example. You set where you can be at 7%, but I also look at where we are and I say, we're not even close to 7%. Our projection in a 1 year, a 5 year, a 10 year won't be anywhere near that as a common face goal. And I look at other pensions. I mean, I certainly can look at my own personal ones, but I look at pensions across the country and I often see what's our goal and that it is a long term. I certainly don't want to play the game of chase, but I want to know against some sort of a benchmark, what are we trying to achieve? Are we trying to achieve between 5.5 and 6? If so, do our members know that? And are we articulating to members what that actually means in their pension? Are we telling retirees, we're kind of on this trajectory of 5.5%. This is what it looks like. And I would say that we have not articulated that message. I've been a plan member for 21 years and never have seen that. The only thing I've ever been provided was a piece of paper that told me, career people pick DMTRS and you will do better than IPERS as a return. And that's what we've communicated to members. And we've not communicated anything different at any point over the last 21 years.
Like, I'm not, I understand what you're saying when you say that, that was the piece of paper that you received 20 plus years ago. I will say that that same communication has not been produced for 20 years forward. So while that you might have received that, please know that that is not and has not gone out and been the same case for the last 20 years. So I don't want to make it sound like we've been misleading people along the way, and because that's not what our intention has been.
I think at the time it was published, it was true.
Right, and I agree, Jessica. But so I think for John and Alan, if you guys could get us just a few different levels of adjustment to our investment policy, what your projections would be on that. And I would say maybe like 5, 10, and 20-year projection on that.
Okay.
For us to look at.
Okay.
And I think, is there anything else for Alan and John before we can let them go? All right. We'll let the two of you go and we'll continue our discussions. Thank you so much.
Thank you,
Thank
John.
you. Thank
Thanks.
you.
All right, so we'll get those studies from Alan and John as soon as we can. I'll get those out to the group and then we can further discuss in next meetings. And I think that in tandem with TCG will be some good pieces to look at together. I don't have much of an update from TCG. Mike, the individual doing the study, had his bilateral hip replacement this week. So for some reason, he hasn't communicated much with me this week. Can't really figure out why. I was hoping maybe on medications, his projections might be better for everybody. I don't know. But I didn't hear anything back. He's hopeful that he'll be back at it next week. And we're still trying to get some data things, tried to figure out. His last request that he made to me didn't make a lot of sense, and I responded back and haven't heard back from him yet. So waiting on that. I'm not sure exactly what he's looking for there, but hope to have some of that here soon. Again, I have that meeting on my calendar weekly, so I'm trying, guys. I really am, and I'm doing everything I can. So with that, does anybody have any other questions? I think on the agenda was also the mailing to members that went out has been received, and we're getting a lot of feedback from retired individuals giving us alternate contact ways. We've gotten several just plain regular address corrections, several phone calls with just some general questions on what things mean. So I think that was good, a good piece of communication to send out. Anything else? You guys are quiet today. All right, well, we'll meet again next Wednesday. Oops. Did you need something? Bye-bye.